So this is lecture video, chapter 1, and we're going to split this chapter into two parts. The first part is going to be week 1. The second part is going to be week 2. So the first part is really the introduction, and then we're going to be talking about basically the initial recording of business transactions. But let's just back up for a moment and just talk briefly about some basic business concepts. So first of all, we have our business, and in this particular sense, we're going to always recognize the fact that the business is going to be a separate economic entity apart from the owner of the business. So it's going to be separate and distinct economically. That's to say that we're going to not intermingle the affairs of the owner in with the business. So whenever we're thinking about any transactions that are affecting the business, we're always looking at it from the business's point of view, not from the owner's point of view. Okay, so that's very important. So the business is going to be a separate economic entity. Okay. So anyway, a business, generally speaking, takes inputs, processes those inputs into outputs. And typically speaking, inputs are usually materials. Think about businesses, they usually take some type of materials if they're a manufacturing firm. Otherwise, take labor, so some type of human capital. Or, and almost all businesses really require some type of financial capital. So we'll call that capital. So that's really the basic inputs of a business. And of course, one could put, I guess another one might be some intellectual capital. Intellectual capital being an idea, or maybe it's a patent, maybe it's a brand name or a trademark. So all of those things would be important inputs in terms of a business. It'd be hard to exist without having at least one or two of those inputs in the business. Of course, then the business will take those inputs, use those in its processes. And what we're talking there is, of course, if it's a manufacturer, we're talking about manufacturing. If it's not a manufacturer, perhaps it's a retailer, we're talking about somehow distributing those products to its customers or consumers. It also would be marketing. So somehow creating demand for its products. Of course, all of that would have to be managed. So there's some type of management function there. And of course, some type of accounting or finance function to be able to measure the financial results of that process. So those are typically the disciplines that are composed of in business environment. There's some other ones, of course. There could be human resources. There could be specialty areas in finance and marketing, manufacturing, distribution and logistics, and so forth. But those are some of the principal types of processes that the business would undertake. And in terms of outputs, I think fairly straightforward. We're talking either goods or services. So depending on the type of company that we're talking about is going to really determine what type of output is going to be ultimately generated. And of course, some companies provide a mixture of the two. So you might have a Best Buy, for instance, that would provide both goods and service function. Other companies provide simply goods. Certainly, a law firm is providing typically just a service function. So the forms of business for us in this class, we're talking about either a service business, the most simple form. Again, we're talking about law firms, realtors, accounting firms, doctors maybe, people who are in business to provide some type of a service to their customers. Second type of business would be a retailer or a wholesaler. A retailer would be taking a finished product, so finished product would purchase the finished product and then resell that. So if you think about somebody like a Walmart, they purchase those products from manufacturers and then they resell it to consumers. They typically do not do the manufacturing themselves. Target, people like that. Wholesalers would be doing it in the wholesale channel. In other words, business to business, B2B. So there you can think about, say, for instance, a beverage distributor. So purchasing Coca-Cola from a Coca-Cola bottler. So they're not actually doing the manufacturing. They're purchasing the finished Coca-Cola product and they're distributing it to retail stores and other outlets in their region. So a beer or beverage distributor would be an example of a wholesaler. And finally, the last type of a business would be a manufacturer. And of course, they're taking raw material ingredients or semi-finished product, and they are actually manufacturing and producing a finished product, which then they are usually selling to a retailer, although the manufacturer could sell that directly to the consumer as well. So there's examples both ways. So depending on the type of business, for instance, Tesla is an example of a manufacturer who sells directly to the consumer through their stores. They take orders through their stores. General Motors is an example of a manufacturer who then sells to a retailer. It sells to an auto dealership, and then the dealership sells ultimately to the consumer. So again, different ways of getting the product to the ultimate consumer. In this particular class, we're going to start out talking about service businesses, and then we're going to shift over to retail businesses, wholesale businesses, where we're going to be talking about carrying products in inventory for sale to consumers. So a little bit more complexity there. Manufacturing is going to be covered in accounting too. So that'll be covered in managerial accounting. So really just the first two areas will be covered in this course. Okay. All right. In terms of the business, we've got two principal objectives. And a lot of times people don't think of maybe the second objective, but the first objective I think is pretty straightforward. We're talking about profitability. Profitability in this particular case means that the revenues, and we'll come back to what that means later, but it's basically the sale of goods and services, is going to be greater than the expenses or the cost of doing business. So if you think about, let's say you were in the landscaping business, you would be hopefully trying to take in more billing from your customers than you are paying out in salaries to the people that work for you and in fuel costs and other expenses of your business. That would determine your profitability. As we go forward, you'll learn that different types of revenues, different types of expenses, but ultimately the idea is, are we making money? That's really the bottom line to the whole business. In this particular course, we're going to assume that we're in business to make money. Certainly there are businesses that are in business for other reasons. For instance, there are nonprofits, there are churches, there are cooperatives that function for the benefit of their members. But in this particular course, we're going to assume that we're in business to make money. We want our revenues to be as high as possible and our expenses to be as low as possible. And that's how we're going to ultimately make as much profit as possible. Now, liquidity is a different concept, and a lot of people don't think about that. Profitability would include growth, would include expansion. All of those things ultimately would have an effect on increasing profitability. Liquidity, though, is the ability to pay your debts when they come due. And this is a function of basically how much cash are we going to have to be able to pay the debts, particularly the short-term debts. And we're most concerned with debts that are coming due within a year. What's our ability to satisfy those debts? So obviously a couple of the big ones are, can we make our payroll? So can we pay our employees? It's pretty hard to run a business without employees. Can we pay the taxes that we owe the government? Again, pretty hard to run a business when you are illegally not paying your taxes. And also paying your suppliers. If you can't pay your suppliers, they're not going to supply you product anymore. So and again, pretty hard to run a business. So liquidity refers to the ability to pay debts. And again, if you can't pay those debts, ultimately the creditors, the people you owe money to, can foreclose on your company and force bankruptcy and liquidate your assets, take your assets, and of course you won't have a business at that point. So the two are very, very important. A lot of people sometimes don't think about liquidity. But if you own your own business, believe me, you will be thinking about liquidity. So a good way to think about this is maybe profitability. Maybe that's your salary. So maybe you're making $50,000 a year and you're saying to yourself, wow, I'm doing pretty well. Okay. Liquidity, however, you might think of that as your bank account. So yeah, I made $50,000 this past year. But I only have $1 in my bank account. So obviously something's going on there, right? And they're two different concepts. Yeah, I made a lot of money, but I don't have a lot of money for which to pay the debts that I might have that are coming due. So I might be profitable in that sense, but my liquidity position is poor. So those are the two objectives of a business, both of which are going to have to be met for the company to stay in business long term. There's also three activities that the business is engaged in. One is operating, and again, that's really more of a day-to-day functioning of the business. That is, again, doing all the things that are necessary to generate demand for your product, to source your product, and to be able to get it into the hands of your consumer. To be able to then account for and be able to pay your employees. So all of those things, marketing, the management, the manufacturing, the distribution, all of that's done on a day-to-day basis would be the operating activities. Then you also have to think down the road, investing activities. So now you're thinking about a longer term growth opportunities. So, hey, maybe I need to be thinking about investing in a factory. Maybe I want to expand into Europe. Maybe I want to develop some new products, things like that. Financing is another activity. How am I going to pay for these things? Do I need to borrow money? Do I need to issue more stock? So, where's the cash coming from that's going to fund these? And again, all these are interrelated. And so that's very important in terms of what the company is trying to accomplish.